This is part 3 of accounting for investments. We're gonna go over held to maturity. Let's go. All right, boring stuff, we're gonna do it very quickly. ASC 320-10-25-1, Classification of Debt Securities, is going to define what a held to maturity investment is. All right, held to maturity securities are the easiest to account for because you keep it at cost basis. You do not adjust the fair market value of the debt security if it's held to maturity. Where do you find held to maturity securities on the balance sheet? Well, it can either be a current asset or it could be a non-current asset, depending on when the debt security matures. If it's within a year, you're going to put it in the current portion of your balance sheet. If it's further out than a year, you're going to put it in the non-current portion of your balance sheet. What are held to maturity securities? I'm sorry that rhymes so often in this. It is going to be a debt security. It's only debt securities. It cannot be equity. It is going to be a debt security like a bond, a US Treasury, a muni bond that you are planning to hold until the bitter end of when that debt security matures. If you plan to sell it before it matures, it cannot be classified as held to maturity. So why does GAAP have all these different classifications for investments? Well, you got to look at the underlying details. You got to look at what type of security. You know, with equities, you're going to get scoped right out of held to maturity. You got to look at the intent. Are you planning to hold this debt security until the bitter end? If you're not, you're definitely not going to put it in held to maturity. And then you got to look at in this case, you got to look at the ability. Do you have the ability to hold this debt security to the bitter end? Because if you don't, then you're not going to class it as held to maturity. So what's the accounting for held to maturity securities? Well, it's going to be very easy. You're going to buy your securities, so you're going to debit held to maturity investment, and you're going to credit cash. Outside of that, you're not going to do anything. You are not going to adjust it to fair market value. You are only going to recognize the interest income as it comes in. You're not going to recognize a gain or loss on this until you actually sell it. So until you sell it, there's no adjustment. It just stays on your balance sheet at cost. Okay, that is held to maturity debt securities. It's very specific. You got to show intent and ability, and more than likely, this is not going to be the classification that you choose. But if you meet that criteria, then you can account for that particular investment at cost basis instead of fair market value. Our next topic for investments, our last one, our part 4, is going to be equity method. This is very different from the other 3, so stay tuned for that one.